Is Getty Realty finally a bargain or just a stock in trouble? Let's find out. You're watching Insightful Value, where we dive deep into undervalued companies and break down what's really going on without the noise. Today we're talking about Getty Realty Corp., a real estate company with a falling stock price that's catching investor attention. This video is for informational and educational purposes only, not financial advice. If you're into uncovering potential gems or avoiding traps, like the video and subscribe to the channel for more no-fluff breakdowns. So, Getty Realty, what do they do? Getty specializes in owning and leasing properties used for convenience stores, gas stations, and auto service centers across the United States. As of now, the company owns over 1,000 properties in more than 40 states, and it operates mainly under long-term triple-net leases. This means tenants are responsible for property taxes, insurance, and maintenance, giving Getty consistent and predictable income. Sounds stable, right? So why is the stock down? In Q1 2025, Getty reported revenue of around $50.6 million, slightly above expectations. However, earnings per share came in at 25 cents, well below the forecast of 32 cents. That earnings miss spooked investors, pushing the stock down over 3% in after-hours trading. From a value perspective, the stock now trades near its 52-week lows, which raises the question, is it oversold or are there deeper issues? On the fundamental side, Getty still shows solid occupancy over 99%. Annualized base rent increased more than 11% year over year, and their properties maintain strong rent coverage ratios. The dividend has been steady too. Getty pays a monthly dividend, which currently sits around 4.5% annually. They've been consistent with payouts over the past several years, making it a potential income play for dividend-focused investors. But there are risks. The company is tightly tied to the performance of retail fuel stations and convenience markets. If gas station demand continues to decline with the rise of electric vehicles, that could eventually affect tenant stability. There's also limited growth upside compared to other real estate investment trusts that focus on more dynamic sectors like data centers or industrial logistics. Also, the EPS hints at some margin pressures that could affect future earnings reliability. Analysts are split. Some see Getty as undervalued with a price-to-earnings ratio below 23 and a reasonable enterprise value to EBITDA, while others remain cautious due to soft earnings. So why might someone consider Getty right now? If you believe in the long-term viability of their property niche and you want stable income from monthly dividends, this could be a reasonable bet. On the flip side, if you're looking for strong capital appreciation or growth, the flat earnings trend and limited sector innovation might be a turnoff. At Insightful Value, we look at stocks like Getty through the lens of value, not hype. We offer deep analysis of companies that might not be trending on social media, but could be hiding real long-term potential. You can find more about Getty Realty and other undervalued opportunities on insightfulvalue.com. If you found this breakdown helpful, hit like, subscribe to the channel, and check out our site. We've got more insights coming your way.